Fear investing, fear losing money when the markets drop, feel clueless when it comes to investing. Hi, I'm David Ye. This is my first video, so I'll start off with a basic investment strategy that you would think most people would know about. It's a simple strategy, but you'd be surprised how many otherwise successful, intelligent people are blown away by what I'm about to show you. This strategy isn't perfect. Every strategy has its strengths and weaknesses. But when I search online for good, concise description and analysis of this strategy, I find mostly incomplete presentations. So I decided to make my own video. So what is this strategy? It's called dollar cost averaging. So let's start off with an example. Let's start off with a mutual fund. We'll call it XYZ. We'll have 3 years of data. It starts off at 10. It's gone down as low as 5, and it's gone up to maybe 7.5. Hasn't broken even. How would you invest this thing? Well, first of all, when you first invest, you don't know what's going to do. It could go up, could go down. But let's say you start to invest and put in $100 every year like clockwork. Buy $100 first year, $100 again. Second year, $100 third year. Well, what do you get? For $100, $10 a share, you get 10 shares. Second year, at $5 a share, you get 20 shares. Third year, when it's 7.5, you get 13 1/3 shares. It's a mutual fund, so you are allowed to have fractional shares. So you'd get 10 shares, 20 shares, 13 1/3 shares. You get 43 1/3 shares. So you put in $300 total. That's $100 each year. And total now, at $7.50 a share, is $325. In other words, you made $25 and the fund never even broke even. So how'd that happen? Well, first of all, the average price, $300 divided by 43 1/3 shares, that's $6.92. That's this blue line. When the stock was, or the mutual fund was $10 a share, you bought fewer shares when it was expensive. And when the price dropped, you were buying more when the stock was cheap. That's the way math works. That little difference there is your profit. Now, what if you bought it all in the beginning? Let's say you inherited $300 and you decided to go whole hog into the markets and you bought it all in the beginning when it was $10 a share. Well, you'd get a loss. $10 a share minus $7.50. Now, what if you had the same mutual fund, but the order of the prices were different? So again, you bought when the stock was 5, when it was 7.5, when it was 10. You still have the same average price. And at the end, you get $433, which is more profit. But if you start out in the beginning and bought all in the beginning, you get $600, which is even more profit. Alright, so now we found a weakness of dollar cost averaging. But what if, same three prices, different order again. It started at 10, you bought when it was 10, you bought when it was going down to 7.5, and you bought when it went down to 5. Same average price. Now, at $5 a share, your account is only worth $216, which is a loss. Well, if you bought it all in the beginning, you'd only have $150. That's even more of a loss. Well, here's another example. Let's say mutual fund keeps going down, you keep buying, you keep buying, you keep buying, and it goes down to 0. Well, that's a total loss. Even dollar cost averaging, you can lose everything. So lesson here is a stock can go to 0. But a basket of stocks such as a mutual fund, like an index fund, it's almost impossible for the fund to go to 0. Unless the whole economy goes, then we're all doomed anyway. So what have you learned so far? In a perfect world, If we had our income today instead of spread over our working lives and we knew the market would go up, lump sum investing everything in the markets now would make sense. But in the real world, we don't know what the markets will do. It could go up, could go down. So, dollar cost averaging at least gives us an edge if the markets temporarily crash. That means keep investing even when the markets crash, otherwise you're not dollar cost averaging. That means you don't look at the price chart and go, gee, it's pretty high right now, let's go and whole hog because it's going to go in higher, or gee, it might be topping, let's not put any money now. You're not following the rules. Dollar cost averaging, there are rules. If it goes down, likewise, you don't say, gee, it's going to keep on going down, let's not buy anything right now. Or it goes down and you think, gee, it's a bottom, let's put in even more now. No, follow the rules. Put in the exact same amount of money each time. Once you start, don't change your plan. So let's take a look at a historical example. This is the S&P 500 Index Mutual Fund. We have data going all the way back to 1987, and it's gone up, bubble went down, another bubble went down, and now we're here. So let's say every year, like clockwork, we buy $100 worth. Every year buy $100, every year buy $100. Total in over 27 years, you put in $2,100. Well, what do we get? Well, every year, does the stock stay at the same price all year? No, it goes up and down. So let's say we were really unlucky and we happen to always buy the mutual fund when the price was at its peak of the year. So we're really unlucky. Well, the average price then would be $40.85. Total return, or total in our account, we put in $2,800, we get $9,700, which is a 246% gain, or a 7.7% annualized gain. Now, just an aside, when we talk about annualized gain, when you look at prospectuses, they give you this average gain, which is kind of stupid, because all it does is take every year what gain it gets, add it all up, and then divide it by the number of years that it's averaging, and that doesn't really tell you much. It just tells you mathematically, yes, there's an average gain, but it doesn't really tell you what the real gains are. And if you wanted to be more rigorous in your analysis, you really want to take a cumulative average. In other words, total gains over total time. So that's what I did over here. You get 7% annual gain. Now let's say we have a crystal ball and we knew exactly when was the low of the year each year to start putting in money. Well, we improve it somewhat. We have an average price now of only $37.80, and our account is now worth $12,000, or 344% gain, or 9.1% annualized gain. Well, an observation. First, at 7.7% return for 27 years, you get $9,700. At 9.1% gain for 27 years, you get $12,000. So that 1.4% difference gives you 20% more at the end of 27 years. That's huge. So, lesson 1, small improvements mean a lot over time, and we'll visit this later when we try to improve on the system. Lesson 2 is start investing early. So, for instance, even with 7.7% gain, if you start at 18 years of age and you contribute $5 a day, every day for 49 years until you retire at age 67, you get $1 million. And to be fair, 49 years ago, in 1965, McDonald's hamburger only costed 18 cents each. So back then, $5 meant a lot. But to be fair also, $1 million is a lot today. So let's say we were late to the party. We missed 13 years of phenomenal growth, and we decided to start investing right at the bubble of the year 2000, right before the crash. And our crystal ball broke and we keep investing at the high of the year. So we keep buying every year like clockwork right at the high of the year because we're just unlucky that way. The average price is now $110.48. But we still made money. We put in $1,500, we now have $2,300. That's 55% gain, or 5.4% annualized. So, dollar cost averaging, it may or may not be better than lump sum buy and hold investing, depending on when you start. And obviously we can't predict the markets. At least dollar cost averaging gives us a slight edge, and it's a good basic strategy to start investing. Any strategy requires discipline. You have to follow the rules. If you break the rules, you have no strategy. And there are ways to improve upon this strategy, but at least learn this strategy before you learn anything else. Good luck. And disclaimers, this is a purely public broadcast and is not intended to be personalized financial advice to any individual specific situation. Each individual's financial situation is unique, and any information in this presentation cannot be relied upon or considered personalized financial advice. I'm not licensed to render personalized advice. Recommendations on any specific security is not intended to address any viewer's particular financial situation.